when we first envisioned this panel, I think a lot of people in the industry right now, and students as well, have had this debate over active management versus passive management. Where does it work? Obviously, other individuals such as Warren Buffett have chimed in, Jack Bogle, individuals from TCW. So we thought this would be a great panel to put together to have a conversation about active versus passive. I'll just very quickly introduce our panelists here. We have Josh Emanuel, Managing Director of Wilshire Funds Management, Meb Faber, Founder and CIO of Cambria Investment Management, Mark Herber, President of Index Fund Advisors, and Lars Lochstoer, Associate Professor of Finance here at UCLA Anderson. And with that, I'll turn it over to the panel.
All right, thank you very much. Very excited to be here with these wonderful speakers. So I heard the panel was on passive versus active, and we used to teach this, we still do at some level. And with passive, it used to mean an index fund in the market, like a Vanguard market fund. But as you all know, sort of the last decade, the notion of passive, I think, has maybe transcended that old notion of just holding the market index or some sectoral index. There's also now a bunch of sort of smart beta passive funds coming online that follow sort of very a strategy that's predetermined that can be implemented with relatively low cost. So the notion of active versus passive seems to be a little bit more diffused than it used to be. And I'd just like to start our panel with just a simple question to see where you guys stand in the passive versus active debate. And in particular, if you were to advise kind of a long-term investor now starting to save, say, for retirement, if you want to think about a portfolio, would you advocate for mainly sort of a classic stock picking active type fund? Would you advocate for factor exposures, low cost? Or would you advocate for just stick to an index fund in the market and maybe something in the risk-free asset? And I'll start with Josh here.
It's a good question. We actually, in our business in Wilshire Funds Management, we interface with those types of solutions all the time. And so, what we are an advocate of is, depending on the risk profile of the investor, if they're a long-term investor and they're early in their investment horizon, we would recommend beginning with, a strategic investment policy that is, more or less the anchor to their investment program. So, if you have a long time horizon, certainly a more growth orientation in terms of portfolio structure, and then we would actually advocate being, dynamic around that overall risk budget to take advantage of opportunities that are presented in the market. And so, more diversified asset allocation approach, much more heavier in terms of the allocation to equities, and then, being opportunistic in terms of identifying areas of, valuation, as well as, opportunities to capture some carry or income in the portfolio. But ultimately, as it relates to passive versus active, that would be the asset allocation. We would recommend something that's more strategic in terms of being passive in that allocation and being dynamically active around that. Now, your question about a growth stock picking portfolio, certainly in the large cap space, that's an area where markets tend to be more efficient. That being said, we're big believers in actually trying to implement active managers, but very selective in the large cap space. So we look for managers that we really believe that can deliver alpha in excess of the overall benchmark. But so if there's anywhere that we're using any type of passive or index exposure, typically to keep costs down in the large cap space, that's where it would be. But ultimately, in areas like small cap, international, in particular in fixed income, we are big advocates of using active managers.
Okay, Meb?
Well, this is a bit of an odd question for me because Cambria, my company, we run both. So we run both active and passive strategies. And I'm a quant, which means everything we do is rules-based. So in my world, in my sort of view outside the window on the world, everything to me is active. Now, what we just mentioned, what did passive mean originally? It meant market cap weighting, and that's it. When John Bogle, Wells Fargo, all those guys did market cap weighting in the 70s, or indexing, that meant you bought the market, done, right? Now, the problem with that is that that's kind of an odd investing strategy to just buy the market if you had to kind of come down from space and say, what is the best investment strategy? That doesn't really make a whole lot of sense. No other world is like, that makes sense to just buy the biggest. I was talking with a friend the other day where we were talking about, I said, market cap weighting. This is when you buy the whole market. This means you invest by size, right? Or I said, explain to me what it is. And they said, you buy the biggest stocks. And I said, right, biggest by what measure? And my friend, she said, well, by like earnings, right? And like sales, the biggest company by sales. I said, no, absolutely not. Market cap weighting is just price of the stock times shares outstanding, that's it. No correlation whatsoever to how big they are. Usually they're the biggest, Apple, right? One of the biggest companies. So for me, and it's been, the conversation's been even more polluted in the last decade, where you come up with what we like to call the cheeseburger index. You could theoretically launch an index fund, passive, on does the CEO prefer cheeseburgers or hamburgers? So we're going to sort by cheeseburger CEOs, and then we're going to weight them by which CEO eats the most cheeseburgers per year. That's a rules-based index, and on top of that, we're going to charge 2% a year. Now, you laugh, but then you see some of these ETFs and things get launched, and you say, that's not so funny. So the best way to describe this in my mind, and we'll talk lots more about this, I'm sure, but is actually a John Bogle quote, right? Founder of Index. He says, the conflict of interest in the industry is not active versus passive, it's high fee versus low fee. So in many ways, you can come up with an active strategy, you could charge 10 bips on it if you wanted to, and it'd be, so the water's been muddled a lot. And so we see, if you had to ask me, my ideal investment choice would be an actively managed index.
Mark.
So I'm here representing the passive side of this discussion.
To my left.
And quite frankly, I'm a little shocked we're still even debating this topic. If you've seen the recent SPIVA study, the Standard & Poor's Index versus Active study, they just came out with their 15-year study. 95% of mutual funds in major asset classes underperformed their index over a 15-year period. 1/2 of the funds that started out 15 years ago are out of business or merged into another fund. When you throw in the element of luck, okay, and this is something that few people think about, if some manager beat their index, was it just a chance outcome or a lucky bet on concentrated investment? It turns out that that's almost always the case. 99.4% of mutual fund managers in one major study looking at 2,000 mutual funds did not have what was deemed genuine stock picking skill. Now, if you don't believe any of that, I've been passing out some of my books. You can read on my website. It's the reason Eugene Fama earned a Nobel Prize for his efficient market hypothesis. Active managers are basically working under the market failure hypothesis, that markets don't do a good job at setting prices. If you have 10 million people trading every day, half of them buyers and half of them sellers, trading some 10 billion shares a day, that is a processing system that brings in the opinions and information of 10 million people every day. And that's why they do an excellent job at discovering what's a fair price. And when prices are fair, the only source of more return is taking more risk. So then it just becomes a question of how you can most efficiently, at the lowest cost, lowest amount of tax, own buckets of risk. And when they were talking about market cap weighting or not, you can easily handle that by designing an allocation of market cap weighted indexes that are large cap, small value in the US. You can do the same thing in international markets, emerging markets. We typically put together 15 different indexes with associated funds that track these indexes and design portfolios for thousands of clients. We manage about $3.25 billion with 2,200 clients, mostly that come over the internet, mostly engineers, doctors, and lawyers. those who really want to dig into the information end up with an index-only portfolio.
All right. We're off to a good, good little
Now would you like to
preparation
know
here.
how I really
like
feel?
it. So let's continue on that a little bit. I wanted to talk about. So I want to sort of focus this panel first on the U.S. stock market because I think it's the biggest market typically for most investors, and then we can talk about alternative markets a little bit later and tactical allocation, these type of things. So following up on this in the U.S. market, and I think broadly, it is true that there's been a trend where passive has gained market share. There's much more money now passively managed than there used to be. But what do you think is the reason for that? Is it the performance, historical performance showed, Faber French, as we all know, I'm sure, had this study in 2010 saying, on average, actively managed fund in the US stock markets hold the market. That means that the average active fund must have the same return as an index fund, but they have higher fees, which makes it a bad investment. On the other hand, some fund might do better. So I'm wondering, what do you think is sort of the reason for this trend in money going passive? Is it performance? Is it just a fee argument, or is it some sort of other, technological reason, easier access or something like that?
Yeah, there's a few factors, and let me start by saying that, and I want to make reference, Mark, to your comment about active versus passive in the recent S&P study, and I'm going to tie it to answer your question, Lars. But they also published as part of that study, and there's other studies that they've done. If you look at that active versus passive, we are at an all-time trough in terms of active outperforming their benchmarks. The two previous periods where we've hit levels of this level of underperformance, active underperforming passive, was 99 and 87, 86 period. So the point is, I only bring that up because we're in an environment today where when you break apart the index and you look at the capitalization weighted index and the valuation dispersion in that index today, which I'm sure we'll get to later, it's very telling in terms of the dispersion that exists and the implications of market cap weighted indices and the price momentum nature of them. Now, that price momentum nature, I think, has really helped fuel the growth in this interest in passive. And what I mean by that is the largest performing companies in the index continue to do better and better as money flows into the index. And what you've seen is because of the access to these new types of vehicles, ETFs in particular. I think ETFs have led to a great deal of passive investing, because if you're an individual investor and you are looking for diversification, you can very easily go buy an ETF and invest in the market. That's very much helped investors get access. But the other, I think, implication is just central bank intervention has really brought a lot of active investors to their knees, frankly. I mean, if you look at what markets have done in terms of price appreciation, and not just equity markets, fixed income markets, real estate, real assets in general, we're at record valuations across all asset classes. And many fundamental active investors will look at a lot of these assets, even quantitative or fundamental managers will look at a lot of these assets and they'll say, this doesn't make sense. I'm not going to buy the top 10, or I'm not going to overweight even the top 10 names in the index. I'm going to buy other names in the index which look more attractive from a valuation perspective, where I know the business is doing better. And unfortunately, this price momentum nature of indexes has continued to propel them higher and higher. And the less active managers look like the index, the more they continue to underperform. And so we've seen more and more funds close. And ultimately that's, I think really helped fuel this growth in passive indexing, because markets in many cases have moved away from fundamentals. And that can prove to be a very challenging environment for active managers, like in 99, like in 86, 87.
Bev, do you have any thoughts?
I have lots of thoughts. A lot of this debate with active and passive, I think, is in many ways confusing correlation and causation, where all of the flows, it's not that it's into passive, it's into low fees. Mm-hmm. It's into low cost. And I say this over and over, it is a wonderful time to be an investor. You can go buy a global market portfolio using ETFs for less than 0.1%. There was an article ETF.com did the other day. It said the cheapest portfolio in the world, and we did a chart on this on my blog. and it's now down to about 5 basis points. If you include short lending, which most of these ETF companies do, and return the revenue to the investors, a lot of people don't know this, but many ETFs are actually free, or they pay you to own them because you get these short lending from the shorts in the fund. So by all intents and purposes, you can get a global portfolio for free, if not negative expense ratio. That's pretty awesome, right? So, and we manage one of the cheapest, the only ETF out there with a 0% management fee. All-in global portfolio gives you 25 bips. That's awesome. Lots of robo-advisors now. Schwab, 0% management fee. Most of the industry, you can get many of these robo-advisors for around 25 basis points. That's fantastic, okay? However, they all do the same thing, and that's fine. That is a good first step. The global market portfolio, totally reasonable, good first step. And many people, they can stop there. We wrote a paper on this called the Trinity Portfolio. We did a book on it called Global Asset Allocation. But we do think there's a lot of things you can do to start to tilt away from market cap investing. A lot of people don't know this, but as an example, this whole active-passive debate, what's the most famous index company on the planet? They manage in the trillions. Vanguard, right? Vanguard runs more active mutual funds than passive ones. Let that sink in for a second. Most people don't know that. Shaking his head.
Not
They have more
assets.
assets,
Yeah.
but by number, they run more funds. Vanguard has funds that charge 90 basis points. They used to have a fund that charged over 1. I don't know if they still offer it, a liquid alts fund, but they launched it a few years ago. So, you know, and what everything we're seeing in the industry is towards this fee compression. Now, this has a lot of ripple effects for financial advisors, for the mutual fund industry, which, you know, we've been on record saying this for a number of years now, is in deep trouble. And you're seeing the flows express this. A lot of these actively managed fund companies, but not just the active managers, the expensive ones, and same thing for a lot of advisors. You know, there's going to be a lot of this automation is going to cause a lot of problems. So look, we think it's a wonderful time to be an investor. If you're going to do indexing and low cost, you should pay as little as possible, which is awesome.
I'll get Gabby.
Yeah, I got just a
start?
few things to
Yeah.
say here. They've been accumulating over there. Those guys have been talking. So first of all, the fact that active managers have only done poorly in a couple of years is complete nonsense. The first proposal for an index fund was called an unmanaged fund. Went back to 1960, okay? This is nothing new. This has always been the case. The problem is you have a financial services industry that makes money from trading, okay? When you're an indexer, you hardly ever trade. So the financial incentive to get the story out on indexing was basically zero, okay? Eugene Fama wrote his paper in 1965 about efficient markets. It has always been the case. This story goes back to Adam Smith, goes back to Hayek. When you have millions of people trading with a number of assets out there, they do a very good job at setting the fair price. When prices are fair, you basically have no opportunity for active managers to win other than by luck. The Vanguard funds, there's an article on my website about all their active funds. None of them have what we call statistically significant alpha. Basically, you have to look at the alpha, the standard deviation of the alpha, and how large of sample size you have. And once you do that, basically all alpha go away. It's gone.
Okay. Any, you want a quick rebuttal? Or?
I rest my case.
You know, all I would say is that, you know, I can appreciate the benefits of both passive and active depending on what you're trying to achieve. But ultimately, the notion that markets are always 100% efficient, you know, the notion, well, markets are efficient to a large degree, but the notion that markets always reflect fair value, that is a point in time observation, right? And supply and demand ultimately is what drives equity prices and fixed income prices, but security prices in general. And all I would say is that, you know, when you look at valuations in different environments, you can see when after periods of time where you see these big dispersions in valuations, you can, if you look at it out of sample, you can go back and actually observe that in certain periods of time, the market is not actually reflecting those observations. And remember, when you're investing passively, you're just buying what the market is giving you. And the more money that flows into those assets, the less from a market cap weighted perspective, the more money that flows into those assets, the less and less they are likely to continue reflecting what the true valuation of those underlying assets are, but really are a function of demand for the market. And one day when that demand disappears, or if that demand abates, then you start to see that narrowing in valuation dispersions. And I think that's an environment where active provides a big benefit. So, they can be very much, we utilize them in complementary business models, but we are big proponents of active.
All right.
Do you charge a higher fee for the active product than the passive?
Of course you do. Of course.
But, so out of curiosity, do you only allocate to market cap indices?
Yes, but we design portfolios that allow the whole portfolio to be tilted towards small in value, international, emerging market. So we're basically creating the tilt based on the asset pricing model. But remember what I said, when all assets are priced fairly, the only source of greater returns are taking greater risks. So small companies are riskier than large, value companies are riskier than growth, international and emerging markets are riskier than US.
Let me just get into that a little bit, because we're moving from the market level to factors. Different, because you could think of a stock as having exposure to different factors.
Sure.
And you could have these tilts, which at some level are active. A lot of people would call them active.
I disagree.
It's okay. It's a tilt away from the market. It means that if you take that tilt, then someone else has to take the opposite tilt. So in that sense, there's at least a deviation from the market. The question is there a difference between, or is there a danger with following mechanical factor strategies, in the sense that you're telling people exactly what you're trading, what you're doing, what is the benefit, and is there some risk to doing that? Maybe we'll start with Meb on this one. You guys.
Well, look, we fully believe in rules-based, and I think, again, going back to it, I think market cap is a great starting point. And I think it's just very suboptimal. And let me give you some reasons why. Take one of the most time-honored investment approaches ever, value investing. Most people can grasp that, right? We have history going back 100 years. Ben Graham talking about it, Warren Buffett, yada, yada. Value investing, talking about Fama. There's enormous amount of research, dozens, thousands of academic papers talk about very simple value approaches. And why does that work? If anyone was here last year, listen to Rob talk a little bit about using long-term valuation metrics and tilts such as long-term PE ratios. This is a classic example, because market cap investing, because there is no link to value whatsoever, lends itself to bubbles. And so if you look back in history, Professor Schiller has done this with a 10-year PE ratio. We've created it for all the countries in the world. You see example after example of bubbles with market cap weighting, because there is no link to value whatsoever. The US hit a PE ratio of 45 in late 99, and you got to kind of at some point take a step back and say, at some point, does reason come into play, and is it reasonable to pay 45 times earnings for US stocks? Was it reasonable in the biggest bubble we've ever seen, Japan, to pay almost 100 times? And then 2 decades of underperformance afterwards. Mid-2000s, everyone remember the BRICS, right? Brazil, Russia, India, China. So excited, emerging markets. China and India hit 10-year P ratios in the 40s and 60s. Everyone wanted them. No one wants them now. Everyone hates them. But this is how value works. And so tilting towards value in any of its infinite sort of flavors, I don't care if you use price to book, price to earnings, enterprise value to EBITDA, has worked great historically and continues to work great. Part of the reason why is it just simply breaks that market cap weighting. And you have to think about this globally too. One of the biggest problems US investors have is called home country bias. We did this in about 20 speeches, stopped doing it, went around the audience, write down how much do you have of the global stock market in the US? Answer was always, of your stock allocation. Answer is always 70%. It's been as low as like 65, as high as like 85. And that's called home country bias. U.S. as a percentage of the world is only half. No one does that. Now, the funny thing is no one does that in Italy. No one does that in the UK. No one does that in Australia. They all put about 70% in their own market, which is a horrible idea because it's what feels familiar. I'm a Denver Broncos fan, you know, because that's what I grew up. It's comfortable. It's what I know. But it's a really terrible investing strategy. Ask anyone in the last 10 years in Brazil, China, Russia, Greece, Cyprus, right? So thinking about the starting point in the way the world looks right now, the U.S. is expensive. There's no question the U.S. stock market is expensive. It's not a bubble. Even John Bogle says U.S. stocks are going to do low single digits. Vanguard kind of keeps him quiet when he says that, but he put out a great paper. There's only a couple inputs, and it says U.S. stocks are going to do low single digits, and we agree. The good news is most of the rest of the world is reasonably priced to really, really cheap. And so you can come up with a lot of these index strategies. We run one. We run 3 that do this internationally for low cost. That simply tilt towards value and away from market cap weighting. And I think that checks a lot of the boxes. Common sense, a lot of history, reasonable, disciplined, rules-based, and most importantly, low cost.
Let me do Mark and then Josh, yeah.
I lost track of the question now.
Yeah, the question is, you know, is there a, in terms of the, there's a reason you might want to invest in factors. If you think different factors provide different risks.
Yes.
The question was really, what's the rationale for, in your mind, for doing that, and should you have a passive approach to the factors, or should you have an active approach?
Okay, so the factors research is based on a passive investment. That's what they are. If you go read the Faber French papers about size and value, they basically take all the market and divide it up into deciles and basically look at long-term data of how the top 10%, the next 10%, the next 10% have done relative to each other. And when they have statistically significant results, I can't emphasize that enough today, basically active management exists because we have not applied statistically significant analysis to their results, okay? But when they looked at these factors, they concluded that there was significant difference in returns between large companies and value companies and and value and growth. Large and small and value and growth. But those are all designed on a passive ownership of those segments of the market and market cap weighted. So if investors want to go beyond, let's say, an S&P 500 or a Wilshire 5000 type investment and diversify into other markets and reach for a little higher return, you need to go into the dimensions of the market that are basically riskier than U.S. large companies, and you want to hold those very diversified, low cost, passively, in a passive way.
Josh?
Yeah, so there's absolutely validity to factor-based investing. There are factor premia that you can capture in the market, and whether it be value, whether it be momentum, growth. There's even in carry, volatility. I mean, there's a whole series of different types of factor premia that you can harvest in the market. Ultimately, just value and size as an example, that is a specific factor premia that has a long-term, there's a long-term positive premium that investors can earn by having a bias towards value and size, and many investors choose to pursue that systematically. But the decision to allocate a portfolio systematically biased to one specific factor exposure is an active decision, to be clear. It's systematically applied, right? And it's applied with good discipline. You can almost say that you're passively making that active bet to small and value, and I'm not being critical of that. That's a well-proven and documented investment approach, but it is an active approach. Now, you can utilizing whether you want to choose value or growth, and we do this today in a variety of portfolios. We actually build alternative portfolios for larger investors, harnessing risk premia in the marketplace through derivative exposures, basically. And we do this in an active type of approach. But I can tell you that factor-based investing absolutely has validity to it. It just needs to, you need to have the right research behind it, the right philosophy and approach. But we also manage a portfolio where we harvest what we call the buyback premium in the marketplace, and we've done a lot of research in this space, and ultimately we can, in the same way that you can show small and value provides a consistent, or a long-term, I should say, level of outperformance, or provides a premium to investors. I could also show you a lot of research that shows that there is a buyback premium in the marketplace that you can harvest, that over the long term there is a risk premium associated with that. Now, that being said, we would not be a proponent of simply allocating an entire portfolio to one specific bias. I think that it's good to have a diversified set of factor exposures in a portfolio. And so we take a more diversified approach when we're building portfolios of factor exposures ultimately. But it is, to be clear, a decision like that away from traditional market beta is an active decision.
Let me give you guys a fun example thinking about this. Two things real quick. One is that the reason we said that our ideal approach in the beginning is an actively managed index is one of the dirty secrets of indexing is the disclosed indexes all get front run. And so in the big indices, S&P, that may only cost the investors about 20 basis points per year, meaning they say, hey, here's what we're adding, here's what we're taking out. People buy what's adding. Remember when Berkshire got added, went up 20% before it went into the S&P. That's a real cost to the investors that invest in the S&P. And we won't even get started on the index of the S&P because that has a committee. You tell me if anything that's active, passively managed that has a committee. Anyway, but so on some commodities indices, that gets up to about 4 percentage points per year. People front running these indices. So when we say if you're going to have an index, it should be non-disclosed or the rules be proprietary, that you're not telegraphing to the market. But one real quick thing that I think is really interesting on as you think about this with your portfolio and asset allocation and the global market portfolio. So we wrote a book, this global asset allocation book, and we looked at 15 of the world's most famous investors. And all these famous investors had disclosed at some point, here's my ideal asset allocation. So Ray Dalio, Bridgewater, Rob Arnott, we talked about research affiliates, Warren Buffett. All these investors said, here's the allocation that I think investors should do. Warren Buffett was 90% S&P, 10% T-bills, I think. Another investor says, no, you should have 25% in gold. Another investor says none in gold, but 25% in emerging markets, right? These hugely different allocations. You would think they would have massively, massively different performance, right? Took it back to 1972 with this is about 13 asset classes. The spread between the best performing asset allocation strategy and the worst was 1 percentage point. And the sharps were all basically about the same. The one outlier was the permanent portfolio, which is a quarter each in, I think, stocks, bonds, gold, and something else. I can't remember. Now, here's the really fun experiment. So as we're talking about active and passive and everything, and why fees are so important, I'm going to give everyone in here, crystal ball, go back to 1972, that I'm going to let you choose the best performing asset allocation going forward the next 40 years. How much would you pay for that? Probably a lot. How much would PIMCO pay for that? And then, however, I'm going to let you implement that with the average mutual fund expense ratio of 1.25%. Okay? Not the average expense ratio back then, which was way north, plus front-end loads, plus all the other good stuff that comes with it. That would have taken the best performing asset allocation strategy, which, by the way, was Muhammad El-Arian from PIMCO, Harvard, which is very endowment-like. So lots in equities, makes sense, lots in growth. It would have transformed the best performing portfolio into almost as bad as the worst, rendering your asset allocation decision completely irrelevant. Then if you said, you know what, actually, I don't trust myself, I need a financial advisor to implement this, so I'm going to pay the average financial advisor 1% a year, and then the average mutual fund 1.25%, you would have transformed the absolute best performing asset allocation strategy into far worse than the worst. And think about that for a minute. What do we spend all the time talking about on CNBC, reading, writing about? How much do we have in gold? 10% or 5%? Are US stocks expensive? How much do we have in tips? What should we do? And so much of the boring blocking and tackling, the really unsexy stuff, is simply how much you pay. And you're seeing this in almost every disruption in the financial services industry, financial advisors, money managers, mutual funds, ETFs, the gamut.
All right, let me pick up on that because I had a question that starts, how do you compete with BlackRock? But I should also add Cambria here. So which is, what we're seeing very clearly are these low fee factor vehicles, which means that I would think a lot more money is going to come into these factor plays. I would worry, if I was a manager or an investor, I would worry about the following. I would worry about increased correlations between these stocks because there's an increased concentration. I would worry about factor premia going away because if the more people play value, book to market value, shouldn't it go away? No. Shouldn't it be priced out? And I'm not even sure what value risk is, to be honest. I know what market risk is, but value risk I'm a little unclear on, personally. Maybe some of you have an idea. So I guess I'll start with you, Josh, which is, if you're a kind of an active manager, how do you, in the world where BlackRock and these type of low-fee funds, the passive but factors, become very big, how do you provide added value? And are there actually opportunities that are presented by these new players?
Okay, so I just want to make sure I answer your question appropriately. So there is, you referenced BlackRock there a couple times in terms of factor-based investing or quantitative strategies. I guess you're alluding to the growing representation of quantitative strategies
and ETFs
on behalf and passive investing on behalf of some of the larger organizations who continue to get larger and larger. How do you compete with those organizations? What I would say is, you've seen those organizations continue to shift their business models, to align with this trend that Meb has referenced, which is certainly a very strong trend towards fee compression ultimately, and we're seeing it in the traditional space, we're seeing it in the alternative space, and that's that is a headwind for a lot of the smaller organizations that maybe are not multidisciplined in nature. So the way that as we see the asset manager landscape evolve over time, it's going to be harder and harder for active managers that are at smaller organizations to compete with some of the larger organizations, particularly as you see fee compression there. The unfortunate part of it is that oftentimes some of the best alpha opportunities or some of the best outperformers can be some of those smaller managers. Now, some of them outperform for the wrong reasons because that maybe they're managing a portfolio from a liquidity perspective that is commensurate with a portfolio size of $200 or $300 million, and they grow to $3, $4, $5 billion. They can't sustain that excess return, but ultimately, it is going to be a challenge for smaller organizations to charge the fees that they do without delivering something extra. And so the question is, what is that something extra that these organizations can deliver? Ultimately, when we look at whether it's whether the consumer is a financial advisor or a family office or an institutional investor, what investors are looking for more and more is more of a solutions-based approach. They're looking for someone to provide them with advice beyond simply, what product to invest in or what their portfolio should look like, but help them solve problems, right? And so whether you look at BlackRock or some of the other larger organizations, or you look at our firm, more and more being a solutions provider, whether it's to a financial intermediary or to an investor or to an institution, that is something that individuals and institutions place value on. And so, competing can either be in the sense of the service or the solution that you're delivering to those potential investors, or ultimately it's going to push more of these managers to lower fees. And that's, ultimately that's a great thing. It's good for the investor. We, with respect to regulation, we're now seeing cleaner share classes. That alone should help reduce that headwind that Meb referenced with respect to higher mutual fund fees, which we're a big proponent of. But I think those are some of the ways that some of the smaller organizations are going to really have to try and compete, and it's not going to be easy. The industry's getting smaller.
Can I just thanks. So to you then, is there a sense that lower fees and more investor flows also equals lower premium for the factors? Is that something that concerns?
No. Listen, Fama and French wouldn't have concluded these were risk factors unless the returns are basically unknown and highly variable. I think we just finished almost a 10-year period where small value tilt did not help the investor. And in the last 2 months of last year, it came roaring back. So these, the excess return for small and value and now profitability, those returns must be random, unpredictable, and long periods of non-existence. When things are predictable, in other words, you know next year you're going to get a 20% return with 100% certainty, the seller of that investment requires a higher price, then the premium goes away. But when the premiums are uncertain, they're pervasive across different countries, pervasive across long periods of time, then you can expect an excess return there, but you can't expect it all of the time.
And one quick note, thinking about the landscape and talk about competing with the BlackRock in the world, the bar is getting set pretty quickly. And to think about this going forward and kind of for the younger students in the audience, think about a career that's future-proof, right? Well, here's the bar right now that's out there. It is asset allocation portfolio costs 0%. That's the bar, all right? For a financial advisor, you darn better well deliver some value other than asset allocation, or you're also a goner. Because Schwab, Vanguard is at 30 bips with a CFA advisor. Schwab is at 28 bips. Betterment at somewhere between 20 and 50 bips. All right, so that is the bar. So a lot of advisors kind of panicked about this, and I'm like, this is the best thing that's ever happened to you. You can move on from the asset allocation decision and spend the time estate planning, tax management, tax harvesting, prospecting, playing golf, right? But all this time you spend on this old asset allocation decision, you can move on, and that's a great thing. Now, if you're on the fund complex side, you better pick an area that's either niche or that Vanguard and BlackRock aren't weighing, you know, in these, the top three, Vanguard, BlackRock, and State Street, right? They have like 90% of all ETF flows. If you want to be in the mutual fund complex, that's probably a pretty bad place to be, by the way. So that's kind of the bar. But there's so many of these niche areas where there's still a ton of opportunity. Some of the challenges is, can you scale that to 10 billion, 20 billion, 100 billion? No, but you don't really necessarily need to. You can still exist in the hedge fund world, 2 and 20. You just got to find an area where you can deliver some value. And of course, it gets harder every day.
Go ahead.
So I wanted to touch just briefly also on this man versus machine. Is sort of quantitative investment going to just take over 100%? What do you think is the role for sort of the old-fashioned financial analyst and fundamental value investor? So,
You want me to answer that?
right.
Well, I'm not sure, when you mean fundamental value investor, so they're analyzing the data and trying to find mispriced
or
equities,
some
is that the goal?
undefinable gut feeling that, you know, the star.
Yeah.
So.
The gut has not served investors very well, unfortunately. The Dalbar study has been heavily criticized, but they routinely come back and say the average investor only gets about 4% a year, while the S&P is doing, 10% a year. They just came out with a 30-year study just the other day. And over that same 30 years, if you small value tilted an emerging market and international, I think you were at maybe 11.5%, okay? So there's, I think, zero opportunity for individuals to go out and speculate and try to find mispriced investments in publicly traded markets, and with a hope of trying to do better than some risk appropriate index fund.
Yeah. Josh?
I'm sorry. I have to opine on this.
Sure.
The notion that there's a 0% opportunity would imply that nobody's doing it, and there are. Maybe there's a smaller number of active managers that are outperforming, but there are active managers that are outperforming. but with respect to the prevalence and growing prevalence of quantitative active managers, we've talked about these trends, fee compression, and ultimately the transformation of businesses in the asset management community. Quantitative investment strategies take the emotion out of the decision-making process, which is, it's great to rely on a computer, an inanimate object, to just make decisions for you, because I will tell you that we use quantitative strategies, and sometimes you can feel very uncomfortable about what the machine is telling you to do, but it's a rules-based approach, and ultimately ends up being actually a pretty good approach. But the other important piece of this is the scalability. So applying a quantitative investment strategy lends itself to a scalable business model, allows you to cut costs, and allows you to adapt to that fee compression that we're seeing in the environment that is ultimately going to happen. And so that is why I think you're seeing more and more firms move into that direction. And in some cases, and some of these big organizations, their quantitative groups haven't actually done that well either, but they are moving down that road. I think that there's going to be a continued growth in the quantitative realm, but that is specific to the equity space, in my opinion. There are segments of the market where I think that you still need fundamental investors that can understand, whether it's a credit manager who is buying distressed investments, who's doing workouts, who's creating value in a very different way, in the private equity space as well. In fixed income in general, I will tell you that utilizing a passive approach in fixed income is something we would not be, I think as a complement to active, certainly, but I think you need to be mindful of credit exposure and duration exposure in a portfolio and be active around that. So I think it depends on the landscape, but I think the big move here is really in the equity space, and I think you're going to see more of it.
And let me comment on just kind of the active passive man machine isn't the big problem here. The big muscle movement is people acting human, and this isn't just a retail phenomenon. So Dalbar got mentioned, but Morningstar presents these a lot of articles called Mind the Gap, where they compare dollar weighted versus time weighted. And this, again, isn't just retail, it's institutional. There's a survey that State Street put out. These managers, I think it's like 400 managers that are collectively managing the trillions, said how long would you tolerate underperformance of this manager before firing them? 99% said 2 years and less. Okay? Let me give you an example of why that's so foolish. Let's say you went back to 1999, and we wrote a book on this topic called Invest with the House. And talked about looking at famous hedge fund managers and value guys, long-term stock pickers through the publicly disclosed filings online. It's called 13F. And so you can track what a lot of these guys do. Very simply, it takes 5 minutes a year when these holdings are public. And so let's say you went back to 99, said, you know what, I like Warren Buffett. He's done a good job. All I'm going to do each quarter is buy his top 10 stock holdings, rebalance every quarter. When they're public, I'll tack on 5 extra days just because I'm lazy. And how is that done? Since 2000, he would have beaten the S&P by 5 percentage points per year. That would have beaten either 98 or 99% of all mutual fund managers, right? So why wouldn't everyone do that? He's an active manager. It's because 8 of the last 10 years, he's underperformed the S&P. So from 2000 to 2007, absolutely destroyed it. One of the reasons, going back to that market cap bubble, almost anything would have beaten the S&P. So massive, massive outperformance. Underperformed 8 of 10 after. And so how many managers or institutions, CalPERS, would be looking at this and saying, this manager's underperformed 2 out of 3. Forget if you're a retail investor talking to your advisor on the phone. 3 out of 4, you're gone. No chance you're still around. 4 out of 5, 6 out of 7, 8 out of 10. But if you'd held through that entire period, and almost the vast majority of that is simply because value did well in the first half of the decade, did poorly after. So this constant chasing performance, even at the decade-long time frame, mucks people up over and over again. And you see this, the themes of the investing conferences. You see it at almost every institutional conference I go to, or whatever it is, people are excited, the topic du jour. But that by far, and we did an article on the blog a couple months ago where we looked at Morningstar's top candidates for mutual fund manager of the decade, 2000, 2010, all have underperformed the market since. And so a lot of this, is just simply chasing performance. And the example right now, is foreign. Foreign's a coin flip versus U.S. Going back as far as we have data, 50-50. U.S. is versus foreign. U.S. has the highest outperformance it's ever had. Number one stock market in the world since 2009. It's basically never happened. And so you're starting to, at least last summer, see this reversion where foreign's really outperforming. But that chasing performance is by far the biggest detriment we see over and over.
Mm-hmm. Can I just add something
Yes,
to that
please.
real quick?
Yeah.
What you're really chasing is luck, and luck doesn't persist. There was a major study done of institutional investors. They looked at the hiring of almost 9,000 investment managers. What they found is for the 3 years prior to being hired, the average fund that was hired outperformed their benchmark by about 3% a year. Now, if that was skill, after they were hired, we'd expect that to continue. But instead of continuing, they underperformed their benchmark basically by the transitional fee cost, which is about 0.5% a year, for the following 3 years. So a 3% alpha went to 0. That alpha is nothing but random chance luck, and people perceive it as being skill. The investment managers package it up and sell it to you as if it's skill. So chasing performance, even that phrase is a misinterpretation of what's going on. People are just gambling. Occasionally they win. Everybody wants the past winnings. Now, Josh talked about that some people can still do well beating the market. Again, it's luck. We haven't got to this question yet, but it reminds me of this question. So, what's going to happen if everybody indexes? It will never happen. We have a human condition called the prediction addiction. We want to make predictions and we want to bet on them. It's human nature. And we like to say when they decide to dynamite Las Vegas, because nobody wants to gamble anymore, that's when you can start worrying about whether passive investing will ruin the market. It's not going to happen.
So let me give it to Josh, and I want to pick up on something you talked about, which is that we've been talking about the U.S. stock market, which is maybe one of the more efficient markets around. And what about this, passive versus active, or if you will, rules-based trading? Is it a greater role? Does it have a greater role in other markets like the bond markets you talked about? Certainly, private equity and these type of markets are very special. Commodities, FX, are there greater opportunities for active management in those markets?
So, I don't want to dispel the active management opportunity that exists in U.S. equities. To be clear, my comment around U.S. or equities versus fixed income, private equity, et cetera, was more around the quantitative discussion. That certainly there's a growing representation of quantitative, rules-based approaches applied to the U.S. equity markets and foreign equity markets as well. I see less of that growth in fixed income. In the commodity space, there's certainly rules-based strategies you can build in commodity space to do, carry, income strategies or carry strategies, so to speak, volatility strategies. So there's certainly systematic approaches that you can apply to commodity markets to capture, premiums or factor premiums in the marketplace. But I don't think that necessarily, I don't have a view on active versus passive necessarily in commodities as an example. But ultimately, I want to make one last point about this. The biggest challenge that people are facing is this, this discussion of emotion. I mean, Mev referenced it earlier, and that's really what kills investors at the end of the day. I mean, Morningstar does these, analyses on, the fund return and then what the average investor got, because they could never actually stick with the fund after 8 years of underperformance. I see this, we interface with intermediaries and we build solutions for them, and the end consumers of those solutions are advisors and clients. And even if oftentimes you index those portfolios for the clients, they still suffer from their worst enemy, which is their emotion.
Yep.
And you probably deal with this all the time, Mark, where
Constantly.
whether or not you tell investors that they need to be passive and they need to stay in markets, you're still fighting that battle every single day with the clients that you have ultimately. Yep. So I point this out in the active versus passive debate because a big problem is just the liquidity that investors have to make the wrong decisions. And that's why, solutions that really that have lockups associated with them or don't have the liquidity necessarily, oftentimes can deliver a much better return over time because it allows the manager and the investment the time horizon to basically build that wealth or allow that thesis from a investment or valuation perspective to play out. And the growth of ETFs and liquid solutions has been great for the investor and has led to fee compression. But I always wonder, what is the actual experience of the investor because of the liquidity they have and some of the decisions that they likely make at the end of the day. But ultimately, I think that yes, to answer your question, equities is where you're seeing more of the growth on the quantitative side. But you're seeing look at BlackRock. How many iShares ETFs are in fixed income today? And I would argue that especially depending on the liquidity of the underlying fixed income ETF, that there's some dangers lurking in some of those products as well that investors need to be mindful of.
So maybe we can think about a little bit about the different markets, but also in the context of market timing. That's something you have had historically some opinions on. So
I'm going to be a bad panelist and channel Charlie Munger here and just say I got nothing.
Nothing on market tactical asset allocation?
I mean, that's a rabbit hole for me because by history I'm a macro trend follower guy, but I feel like that's a whole another hour panel after this. Like we even start to go down that, I'm going to talk for 45 minutes. So I believe in it, yes, but again, my core is everything's active in the first place. S&P market cap weighting is a trend following methodology. And this is one of the reasons, by the way, why investing is so hard. And there's been 3 papers that have come out on this in the last 5 years. The first was by some friends that are actually a managed futures shop, charge a huge fee, 3% a year. They think they're worth it. I like them, so I like to think that they are. But they did a paper on stock market distribution, and it's called the capitalism distribution. And they took all stocks back to the 80s, and what they found was that 2/3 of individual stocks, and this is like the Russell 2000, 2/3 of stocks underperform broad-based index. Roughly half, almost half, have a negative rate of return over their lifetime, and about a quarter, or maybe it's about 20%, basically go to zero. And the whole takeaway from this is that the very few big winners, the Amazons, Walmarts, McDonald's, Apples of the world, deliver such a magnificent performance that it makes up for all of the underperformance. It's like only 20% of the stocks deliver all of the gain. And one way to guarantee to own that is through a market cap index or other broad-based indices, but that by its core is a trend-following index. So we actually believe that trend-following works well in lots of other markets. We think managed futures is my desert island investing strategy. Again, the same problems persist where it's expensive. And there's been a couple other people that have published on this, but that's one of the reasons stock picking is so hard. But as far as market timing, on the valuation side, there's 2 areas. If you put the stock market into a valuation quadrant, uptrend, downtrend, expensive, cheap, the best historically is cheap uptrend. But surprising to a lot of people is the second best is expensive uptrend, which is where we are now, right? The problem comes is when that trend ends and you go to expensive downtrend, and that's when things get really nasty. But hey, we're in year 8 bull market, so who knows when that'll happen.
Can I just add something to that? Sorry, Mab, but that makes no sense. So first of all, the reason market timing is so hard is the exact same reason that stock picking is so hard. The winners are very highly concentrated. In the average year, it's about 4 or 5 days that make up the entire return for the year. The S&P is about 10% of the year. We get some 2 and 3% days throughout the year. If you're not invested during those days, you didn't get your 10% a year, okay? Now, there's all kinds of other ways you could invest throughout the day and randomly come out and still get your 10%. But the concentrated returns that show up in the bell curve, that's why we have the random walker here. By the way, there were boxes of random walkers out there. Somebody has an empty box. This random walker needs a box. So if you check your boxes and you discover that your box is empty, here's your random walker. But the results that show up in the tails are basically all of the action. And the reason we diversify, hold all the stocks, and for as long as we can, is so that we capture those tail events. Now, unfortunately, you get both sides of the tail, okay? But you cannot miss out on the positive. And if you have the whole distribution, on average, you get the average. What the random walker actually shows you is that all expected returns start in the middle. That's caused by changing prices. So here's a brain twister for you. Why do prices change? Prices change so that the expected return stays the same. What you think on that a minute?
Yes, please.
I got to keep going for a second. I told you this was going to be another hour, but you asked for it.
Okay.
We wrote a paper on this exact topic. It's called The Best 10 Days Myth. And the problem is, first of all, that's not the stock market's distribution. I can't see it from here, but it doesn't look like it. I can tell you where 2/3 of the best and worst days occur.
It is.
Historically, in every single stock market around the world. And that's in a downtrend. And there's a very simple reason why. And you see this argument all the time for buy and hold, and it drives me nuts. A chart from BlackRock or whomever, I'm not going to call it BlackRock here, say, if you just miss the 10 best days in the market, look what this does to your return. Obviously, it's terrible. Normal stock market returns are extreme, and so a lot of these outliers drive the returns. They never show you the chart that says what happens if you miss the 10 worst days. Unbelievable returns, right? 2/3 to 70% of those days occur in the same place, and it's called volatility clustering. It occurs when the market's already going down. And the reason is simply because volatility expands. So all the good and bad days happen near each other. Think 2008, 2009, 2000, 2003. And if you take a very simple trend following metric, I don't care what it is, 200-day moving average, 10-month moving average, whatever it is, you overlay it on the stock market, you can predict when 70% of those days are going to occur. Now, if you sit out, if you simply invest in markets when they're above the long-term moving average, sit out when they're out, and a key part of this is you sit in T-bills, so you don't just earn nothing. You get the same return as the stock market, much lower volatility, much lower drawdown. It happens every market we've tested in the world. Okay, so the thing people get wrong about it is they always assume that market timing, you're trying to get some magical, fantastical gain. So say the stock market does 10% a year. That's on the high side, but just for rounding. All the market timers are trying to get 15 or 20. That's not going to happen. That's not how trend following and market timing works from the way that we talk about it. It works because it reduces your volatility and drawdown and gives you a higher Sharpe ratio. Don't believe me, go test it on your own. Every market in the world, it's worked historically. And it's because these volatility gremlins, you're avoiding the good and the bad. So you can have a higher risk-adjusted return by avoiding the best and worst days. Anyway, name of the paper is called Where the Black Swans Hide. It's free online.
For every black swan, there's a green swan. Remember that. They're both ends of the distribution. And that is the distribution of a globally diversified portfolio, 600 months.
All right, let me ask you about hedge funds for a second. Obviously, they're active vehicles. Historically, fee structures have been with a performance fee, which means some 220 was the old school, maybe 110, depending on the fund. But what that means is that every time you're taking off a lot of the upside as an end investor. And so let me start with you, Josh. What do you think is does hedge fund have a role going forward?
Yeah, I mean, I think that alternatives in general and hedge funds as part of that absolutely have a role in an investor's portfolio. I think what you're going to continue to see is a similar trend that we're seeing in the traditional side, which is that move towards fee compression. And you're seeing the factor-based investing being implemented in the hedge fund side as well. So more kind of beta, alternative beta type solutions that are being made available to investors through a whole host of different types of strategies. But that being said, I think the challenge that investors, and this is the issue. You've seen a lot of alternative products become available in a retail format, in a liquid format, and the challenge there is two issues. One, that the fact that they are now available in a liquid format is probably a function of the fact that there's some degree of dilution that's taking place in the strategy that is typically not present in a liquidity-constrained alternative approach. It doesn't mean it's not a good solution, but you're giving up some of that illiquidity premium that you would get from an alternative strategy in a more kind of institutional structure. But the other problem there is you now have individual investors and sometimes financial advisors that are using these alternative products, and they don't really know why they're using it or how to use it. So, ultimately, if you're going to use alternatives in a portfolio, you need to understand what part of your risk budget you're trying to substitute, right? You're trying to substitute your equity risk budget, your fixed income risk budget. What type of alternative product should you use for each of those respectively? So, when we use alternatives, we don't just, plug them into a portfolio and, not really think about the implications or how we're substituting that risk. We more specifically think about, okay, am I trying to bring down my equity risk? If so, should I use an equity hedge manager as an example, or an event-driven, or it just depends on what you're trying to do. But ultimately, a manager that's going to get you more of a risk asset type of profile ultimately, and get you perhaps some equity beta as well. But the other challenge that you've had is, Meb referenced, trend following strategies. Great strategy over the long term. The unfortunate part of it is that there's a number of global macro managers as an example that will use trend following applications, and this has been a very hard period of time. There's been some pockets of opportunity, 2014, 15, but over the past, over this bull market, ultimately there's been a lot of choppiness, right? There's been a lot of volatility and inflection points, and some trend following managers have really struggled through those environments. Their strategies can get chopped up in those environments, but over the long term, these are strategies that have a valid place in the portfolio, and when complemented with different approaches, can really do well. The last thing I wanted to say is, in terms of alternatives, there's some cleaning up that's needed to be done in the alternative side in terms of the hedge fund managers. There's certainly some bad players out there. There's some managers that just did well because they made one big bet, and so I think that is an area where I think manager due diligence is of utmost importance. Understanding what you're getting, understanding why this manager is outperformed, how they make decisions, having an operational due diligence associated with that manager. These are all things that are very important to not only identify where there's sustainable alpha in those portfolios, but also to mitigate some of the operational risk that comes with them as well.
Can I say something about hedge funds?
You can, man. Sure.
So who read the Warren Buffett Berkshire Hathaway shareholder letter that just came out? Oh, well, maybe I don't even have to tell the story. Warren, 10 years ago, he put a bet out there. Does anybody want to bet that they can find hedge funds that'll beat the S&P 500 over the next 10 years? Well, almost 10 years have gone by. I think the average of the 5 hedge fund portfolios that were assembled is something like a total return of, 35%, and the S&P had a total return of 85%.
Mark, I'm sorry to interrupt, but that's not their benchmark, right? I mean, let's be fair. If you're gonna make that reference, it's like taking a fixed income manager and saying what % of fixed income managers have outperformed the S&P. I'm sorry to interrupt, but it's not really a fair comparison to make when you're comparing a hedge fund manager.
But that's not even the best part of the story. The best part of the story, this was protege versus Buffett. Is they put the money, the collateral, so it was a donation, they get to choose donation charity. I think it was $1 million each?
Yep, no, $500,000 each.
$500,000 each? Yep. They put the money, the collateral, in zero coupon bonds. Guess who won the bet? Not Buffett, not protege, zero coupon bonds. So the bonds had such a massive run because interest rates went down so much. They, I think, sold them and fully funded the bet like 6 years in. I find endless humor in that.
Yes. Well, to Josser's point, a hedge fund actually is not an investment strategy, it's a legal structure. And there are so many different strategies, it's basically the Wild West. There are very little rules, very little regulation. Imagine if half of the mutual funds went out of business in 15 years.
That would be great.
My guess is that's what they did. That's what they just did. In the last 15 years, according to the Spiva study, 50% went out of business. My guess is the hedge fund business, and this is unfortunately a guess, probably 75 to 80% of hedge funds that started 15 years ago are gone. And it could be more than that.
And that's the challenge too, is that, hedge fund back in the 70s or when Winslow Jones was doing it, it meant something. That phrase meant something. And traditionally it was mostly long short equity. right? As a fund that was uncorrelated to the market, you bet on your longs, you bet on your shorts, and you didn't really, it means nothing now. You have hedge fund strategies and mutual funds in ETF format, you have low-cost hedge funds, you have high-cost index funds that look like it's all a big mess now. And all that really matters at the end of the day is your total return after all fees and taxes. Taxes is a really important one that most people don't pay attention to because it's not that sexy. But mutual funds more efficient than hedge funds by a mile, and then most ETFs way more efficient than mutual funds. Right. So it's a term that at this point is sort of lost all meaning.
All right, I want to get to some Q&As too, but I want to have one last question that I want each of you to comment on, which is just we have a lot of students here, people thinking about the direction they want to focus on, maybe the last year or so, and so what are your thoughts on that? And we'll start with Josh.
You know, the landscape's changing quite a bit. We talked a lot about quantitative investing, and we're hearing managers move more and more towards these quantitative solutions. And so, I think that having some quantitative background is healthy for all students. Whether that means that you choose to pursue a PhD in finance or financial engineering, or just simply having a better understanding and appreciation for utilizing quantitative tools as part of being an investor. And as an example, you're seeing more and more fundamental managers today still deploy their fundamental investment process. So you could still be a stock picker that does company level analysis, but that just makes you an investor in terms of an analyst ultimately that's researching a company. But once you research that company, you have to build a portfolio. And that is as important as actually researching the individual company as a fundamental manager. And that's the one evolution that I think has been much needed, that is finally starting to take hold in the marketplace, which is then the portfolio construction piece, understanding the risk budget. What percentage of your contribution to risk or your tracking area is attributable to an individual name, or what are your factor biases in the portfolio, or your exposures. And having just a modest quantitative background can help you make these decisions and better understand how you're managing an underlying portfolio. So I think it's always helpful to have that background and that understanding. The other piece of the equation that I think is really important is marketing. I think that having an understanding of marketing is very important, because it's funny, we look at asset managers today. You can find some great managers out there with great numbers who can't raise money. And it's because they don't have distribution. Distribution is extremely important even today. And certainly, given e-commerce, even in the financial business, there's different forms of distribution, but it's extremely important. Whereas you could have a manager with just average performance, but they've got great distribution, and so they've raised a lot of money. So having a marketing background is also something that I think is very helpful. The last piece that can be a very valuable complement to a business degree is a law degree. And it's important for a few reasons. A, to the degree that you want to pursue something more in the private equity space or in the fixed income or credit space, having a law degree can be very, very valuable, whether it's reading loan covenants as an example or dealing with workouts. A law background can be very healthy. The other important part of it is just understanding the changes in the marketplace and the implications of regulation. I can't tell you how much regulation is shaping the financial community today, whether it's in terms of how people give advice, what they charge, what is prohibitive, what's a prohibitive transaction, what's not, and how to understand how to position yourself given the evolving landscape from a regulatory perspective. So I think those are a few areas for you to think about from an academic perspective as you further your education. If you're thinking about other complementary skills, those are a few that I think are noteworthy.
Great. Meb?
This is directed to students, but I think it also applies to anyone here who has a job at a company that's not their own boss. Is most of the way that people go about getting a job is the exact opposite way you should. And it's you send someone a resume. Hey, I love your company. I get these emails almost every day. Meb, love the podcast. Here's my resume. Can you give me a job? Basically what they say. The millennial may have a winky face in there. And he said, do you realize what you just asked me? You asked me to take 30 minutes out of my day reviewing your resume, then calling you, then essentially you trying to get me to pay you $100,000, right? So all you're doing is 4 asks, time, money, everything, and you've demonstrated nothing. The correct way to go about getting a job is you prove yourself of such immense value that the person has no challenge not to hire you. Most people we've ended up hiring said, Meb, look, here's 10 things I noticed you're not doing in your company, and I'm going to send you some ideas. You may not like them, but here's some ways I can help. And then 2 weeks later, hey, I'm just going to keep sending you these things, and here, one of the guys we hired, here's a 10-page PDF on this. And then a month later, hey, Meb, I see you talk about this idea. Why don't I take this off your plate, and why don't I do it? And 3 months from now, if you like my help, whatever, we can talk about, et cetera, et cetera. Maybe I'll do this on nights and weekends, right? And that's how you become like of value. And most people, they don't do that because why? That's a lot of effort. That takes time. Instead of just sending a 10-second email, hey, here's my resume. What's the return on that? Probably 1 out of 10 million. And a very similar thing, if you currently have a job somewhere, and Theo Epstein of the Cubs is talking about this in a great interview, and he said, look, go to your boss or go to one of your people and think or ask them, say, what is the 20% of your job you hate the most that I can take off your plate? And so 1, you're going to learn, you're going to do their job essentially, and 2, you're going to make their life much happier and you're of an immense value. Again, the challenge for most of these are they're hard descriptions. It takes effort, but to me, that's the way, and that's the way it's always been, but it's the way we've seen out of hundreds, if not thousands of people email me about a job, none of them do it.
Great. Mark?
Let's see. So, as I see it, the biggest problem for investors today is this behavior gap that we've talked about. The difference between an active fund and a passive fund might be 2% a year, but we're seeing 6% a year differences for the average investor versus an investment. Okay, so it's the difference between an investment and an investor. Probably the most important thing investment managers can do to narrow this gap is to become registered investment advisors, be in a role where you're a fiduciary for the client. In other words, you're obligated to do what's in the best interest of the client, and focus on educating clients about the reasons that they're doing so poorly on average. And you can do that a number of ways, but even before you can get to that point, you have to have a good, solid education around the academic research that comes out of a lot of different universities. And then maybe you get a certified financial planner certification to help with the financial planning side. Unfortunately, a lot of the fundamental investment management that's taught in schools today is becoming less and less relevant for all the reasons that I've just laid out for you. And what's more important is that you understand efficient markets, asset pricing models around these factors that we've been talking about, and why investors psychologically do so poorly holding their investments.
My question to Josh is, have your shop done any research in terms of any crowding effect from factor investing, such as, giving you an example, like in the hedge fund blew up in August 2007 because a lot of the quant strategy, they're in this similar strategy, and when everyone wanted to exit, it just blew up. So I'm just wondering whether the factor-based type of investing, you guys done any research that might have this type of experience sometime in the future?
Yeah, so we, I will say that it's something that we're concerned about. We can kind of see and process all the money that's flowing into a variety of different types of factor-based approaches, no question. We haven't done a survey of the marketplace per se to see how much crowding effect there is in value or growth or certain areas. But we are very mindful, when we deploy a strategy, whether it's a manager or it's a swap-based exposure, we're very mindful of the assets behind that and whether or not there's some crowding taking place behind those strategies ultimately. But if you think back to the quant debacle of August of '07, those were active quant managers, and they were they had both value and growth aspects to their investment processes. And there was ultimately a lot of correlation between what they were doing. And I think you still have the risk of that taking place again in the market, which can lead to very pronounced short-term corrections in a lot of these strategies, particularly in periods of reversion. So we have no published study today to really reference, but it's something that we do spend a lot of time looking at when it relates to manager due diligence or understanding a specific exposure that we're implementing for clients.
And this is the big topic du jour in the quant world, where on one side you have Robert and I Research Affiliates, and on the other side you have Cliff Assets and AQR, and they've been kind of going back and forth. If you're a quant nerd like me, you find it pretty interesting and humorous. The rest of the world probably doesn't. But the concept is, do flows change factors? And I think the answer to that is equivocally absolutely. So you've had things like when French Fama published price to book, and everyone knows price to book works, and all of a sudden started using value, and hundreds of billions are going into value strategies, and DFA is getting huge. Well, what's been the worst performing value metric since then? Price to book. It's not surprising. A great example right now is dividends. Dividends have worked for as long as you go back. It's one of the most nonsensical investing strategies on the planet. But at times, there's been times when dividends as a factor, which is basically a value exposure, not a very good one, it's kind of a crappy value exposure. But if you're just looking at dividends, you look at, say, 1999. The reason dividends worked historically is they traded a valuation discount to the overall market. It's called around 20%. Late 1999, dividend stocks traded a 50% valuation discount because no one wanted dividend stocks. They wanted Pets.com, CMGI, Celera Genomics, all of those, right? So what happened since 2000? Dividends have had massive outperformance. Didn't even have a bear market 2000, 2003. Billions and billions of money going into all these dividend funds for no reason in my mind. And what's happened, you don't have to believe me, you go type in your favorite dividend ETF or fund into Morningstar and look at the holdings and their valuation. VIG, the biggest dividend ETF, 20 billion plus, has the most nauseating valuation metrics because flows change factors. And all of a sudden, dividend stocks traded a valuation premium for the first time ever in the last few years to the overall market going back to the 60s. Now, the big question is, can you do anything about it? And that's where a lot of the research is coming out these days. You're seeing a lot of papers that show, hey, if you just tilt away from factors, and Research Affiliates has an online portal now where you can type in a factor and get the relative historical valuation, which is pretty cool. But the question is, can you do anything about it? Can you change your portfolios to take advantage of that? And a lot of this simply goes to investing in what's worked the worst, the last 3 to 5 years or whatever it may be. So it's kind of like it all ends up in the same place. You want to be chasing what's done poorly rather than what's popular.
So about 15 years ago, William Bernstein wrote an article called The Big Lie. The big lie was that there were some components of the market that were inefficient, which you quoted in your question. I was just looking at the SPIVA study. People often quote emerging markets, okay? 90% of emerging market equity funds underperform their benchmark. International equities, 89% underperform their benchmark over 15 years. When there's a publicly traded market, they're all efficient. That is your best assumption to make. And if I were you, I would index that entire portfolio.
Somehow I guessed that. Yeah, one more question.
I'm Suzanne Moline, and I feel kind of uncomfortable admitting this, but I work for a hedge fund, so I feel very unpopular. But I actually specialize in looking at micro cap stocks. So here's a question for you as sort of more money flows into passive investing. Here's something that I've seen literally at some companies I'm looking at right now. So you have these micro cap companies, tiny little companies, and you just don't see the best management. I mean, sometimes you see stuff that's pretty egregious, just like gross value destruction by management. And when you look at the biggest shareholders, you have a bunch of passive investors who this is like a drop in the bucket of their portfolio. Nobody's paying attention, nobody's holding management accountable, and it's just really sad. So what do you think about that?
The best part about hedge funds, by far, is the vast majority of them have skin in the game. meaning the fund managers put their own money in our funds. And this comes from someone, I put 100% of my net worth in our funds and strategies. Average mutual fund manager, 70%, and this is Morningstar data, asset allocation mutual fund manager has 0 in his own fund. 0. Under 100,000, it's like 80% have nothing invested in their own fund. And so that becomes a really big problem. And particularly in areas, I think, that are less efficient, I think absolutely there's opportunity. I mean, if you look at some of the best performing funds of all time, we just did a podcast recently with Ed Thorpe, you know, who printed money at 15, 20% per year for decades. Jim Simons at Renaissance, right? He charges 4 and 40 back when the fund was even open. So there's absolutely active managers that have been doing it for decades. And I think microcap, if I was a hedge fund manager in the equity space, absolutely, that's where I would be.
Yeah, I would agree. I mean, that's where the most inefficiencies exist in the marketplace, even though they don't exist.
They don't.
But
If they did.
but
I'll explain
if
it
they
in a
were
minute.
to exist, they would exist in the microcap space, certainly. And the issue there that one needs to be aware of, and any manager, is ultimately liquidity, right? What are you can invest in these companies. There may be an opportunity to be an activist investor in these companies, but you want to deploy the right manager to invest in that type of strategy. You want to be mindful of their liquidity and their size. And really how they hedge their position ultimately, because if you're an activist investor that's going to get involved with a microcap company and take a big position, you want to make sure that investor is appropriately implementing that exposure and then appropriately hedging that exposure as well, because it can come with a lot of volatility, and you can become the market many times in strategies like that.
Yeah, and I was asking not so much as where investors are going to put their capital, but more from like a systemic point of view, because
Yeah.
I do
I
think
see.
that there's shareholder accountability, and if you have all passive investors, you lose some of that.
There's no question. Yeah, you do, and that's one of the shortcomings of, public markets today, right? You can there's greatest accessibility to capital. And when there's too much money flowing into any market, ultimately that leads to bad investments, and it leads to bad decisions on behalf of management. And whether it's in small caps and just money going into these companies and nobody's really investing responsibly, or it's private equity managers levering up to pay themselves dividends through levered acquisitions. We're seeing this across the board, which is a function of easy money, which goes to my earliest comment as part of this panel discussion.
But I'm interested in what you have to say about it, yeah.
Yeah. So first of all, markets are efficient. If you look at the small cap core portfolio as an asset class, 95% of managers underperform their benchmarks. If you go to small cap growth, it's 99%. That is the definition of efficiency, when all these managers cannot find mispriced investments. Now, Roger Trinworth is back there. Raise your hand, Roger. Roger's from Dimensional Fund Advisors. How many have heard of Dimensional Fund Advisors? Okay, that's where you want to work when you get out of here. That is the premier investment firm in the world, as far as I'm concerned. They started the company with the bottom 20% of all stocks weighted by market capitalization, which was called the 9-10 fund, which was the microcap fund.
Which is an active bet.
So it's not an active bet. It's a passive holding of risky assets. You heard her define the ultimate risk. These companies are mismanaged. What they really end up having is what's called a high cost of capital, because their future returns are so uncertain. The cost of capital to the firm is the expected return to the investor.
Okay, but so just backing up from, we know you're not going to invest any money in an activist small cap fund manager, but from a systemic point of view, do you see what I'm saying? I'm asking about it, shareholders sort of holding management accountable, or we don't care if they just sort of destroy value and go bankrupt, and
that's the function of the board of the company.
Yeah, well,
right. Well, so first of all, very few companies last forever. If you look at the original S&P 500, you go 40 years later, there's only 75 left, okay? This is creative destruction.
Okay.
And so the ones that are doing it right will grow into a mid cap or a small cap, whatever's next, and ultimately large cap. And those that don't, go away. And
Okay.
but that is a great place to passively own that asset class in the small cap arena. The average returns, what are they, about 12.5%, something like that for 89 years versus a 10% large cap. And that's because they're riskier.
Yeah, they're definitely riskier.
It's a passive holding of a risky asset. It's not considered active. Go ahead, question?
My name is Alan Risch, and I graduated from UCLA, the Graduate School of Management, so long ago that my investment professor was Benjamin Graham. After he retired from University of Chicago. My question is, when you compare, and Meb says a little bit about it, when you compare your returns, my advisors always show me, the various index and then what my actively managed funds do, but they never consider the taxes. And in a good market, I end up paying a lot of taxes, even though I might be doing a little bit better than the index.
This is a major problem. It's one of the reasons that you passively hold your portfolio so you don't have capital gains tax.
I would also say that this is one of the reasons that ETFs are far superior to mutual funds. The SPDR ETF hasn't paid a capital gain distribution since launch in '97, and that's a structural issue. And they just have a massive benefit over mutual funds, so vast majority of mutual funds. But there's also a bunch of areas that's interesting about taxes, and I can give you a theoretical example right now on dividends. And we did a fun thought experiment on this. If you could replicate the S&P 500 but not pay any dividends, you end up with about a 20 to 400 basis point outperformance after tax. And I want you guys to think about that because it's actually really easy to replicate the S&P without dividend-paying stocks because you just do a slight tilt towards value. But no one really does that because what gets marketed, nominal performance, no one's really marketing the after tax. But the tax part of the puzzle is probably the least paid attention to part. And this is one of the beauties of a lot of the robo-advisors doing now, a lot of the tax efficiency and tax harvesting. But if you could probably add any measurable alpha for an individual portfolio, that's probably the best area.